All right, so you ready to dive into some business and finance?
Always ready.
We've got this classic investment book, Why Stocks Go Up and Down.
Yep.
And we're going to try to pull out some of the key insights that'll help you really understand companies and the stock market.
Yeah, it's a fantastic foundation.
Yeah.
We're going to break down some of the jargon and really give you a framework for thinking about investments.
Exactly. And to kick things off, we're going to journey through the basics
Okay.
with the fictional Jones Mousetrap Company,
Okay.
or JMC.
Love it. Yeah. Using a fictional company, I think, is such a good way to visualize how these concepts actually play out in a real business.
Yeah.
Yeah.
So picture this. Mr. Jones, our ambitious entrepreneur, is building JMC from the ground up, right?
Mm-hmm.
He buys $60 of metal and wood for his mousetraps.
Right.
Those materials become assets on his balance sheet.
Absolutely.
Right.
And on the flip side of that balance sheet is his initial investment, his equity in the company. And it's important to note that equity isn't the same as cash on hand.
Right.
It represents his ownership stake.
Got it. Okay, so now Mr. Jones gets to work and uses $30 of those materials to build 15 mousetraps.
Okay.
Now, I'm curious, is there a difference between the cost of those materials just sitting there
Yeah.
and the expense of them once they're part of a product?
That's a great question.
Yeah.
And yes, there is.
Okay.
The book highlights the distinction between cost and expense. So think of it this way. The $30 worth of wood and metal used to make the mousetraps
Okay.
are a cost that contributes to their value as inventory.
Got it.
On the other hand, expenses are things like rent or utilities or marketing, which are needed to run the business as a whole.
That makes sense.
Yeah.
Okay. So let's say Mr. Jones needs to hire someone to help build more traps. He brings on Arbetter, our newest employee.
Right.
How does Arbetter's time factor into costs versus expenses?
Well, the time that Arbetter spends directly building mousetraps would be considered a cost, added to the value of each trap in the inventory.
Okay.
But any time spent on general tasks, like cleaning the workshop or running errands, would be a general business expense for the month.
Interesting. Now, paying employees means Mr. Jones needs more cash.
Mhm.
He could dip into his own savings,
Right.
but he decides to go to the bank for a loan.
Okay.
What are the implications of that choice?
So that brings us to the concept of debt financing.
Okay.
By taking out a loan, Mr. Jones is leveraging outside capital to fuel his business growth. However, this decision comes with a cost: interest payments.
Right. And the
Yeah.
bank isn't just going to hand over money without assessing the risk, right?
Right.
Right.
They want to see that Mr. Jones is serious about this business,
Oh, sure.
and they'll likely require him to put up some of his own money as well.
Okay.
This shows he has skin in the game and is committed to JMC's success.
Mm-hmm.
The loan becomes a liability on JMC's balance sheet,
Okay.
while the cash received from the loan increases the company's assets.
Got it. Okay, so Mr. Jones has his loan. He's got Arbetter building mousetraps.
Yeah.
And he is ready to sell. Let's say a month goes by and he's turned a profit.
Okay.
What happens to those profits?
That's where things get interesting.
Oh.
Mr. Jones has a few options.
Okay.
He can take a salary, which would be an expense for the business.
Okay.
He can reinvest those profits back into JMC for future growth,
Hmm.
or he can distribute them to himself as dividends,
Okay.
which would reduce the company's retained earnings in cash.
So there are trade-offs to consider.
Yep.
Each option has a different impact on the company's future and Mr. Jones's personal finances.
Exactly.
But for now, let's say Mr. Jones wants to make JMC more official.
Okay.
He decides to transition from a sole proprietorship
Mhm.
to a corporation.
All right.
What are the key differences between these business structures,
Okay.
and how would that affect JMC?
That's a big step. Sole proprietorships are easy to set up,
Okay.
but Mr. Jones is personally liable for any debts JMC incurs. If the business goes under, creditors can go after his personal assets. Corporations, on the other hand, offer limited liability,
Okay.
meaning Mr. Jones's personal assets are protected.
Gotcha.
However, they're more complex to manage and face double taxation.
Double taxation. That doesn't sound very appealing.
It can be a drawback, yeah.
Yeah.
Corporate profits are taxed once at the corporate level,
Right.
and again when dividends are distributed to shareholders like Mr. Jones.
Okay.
However, incorporating JMC also comes with benefits.
Okay.
It opens the door to raising capital more easily by issuing stock to investors.
Right.
This could help fuel even faster growth for JMC.
So let's imagine JMC is officially a corporation now.
Okay.
What changes?
Well, now we have to consider corporate governance.
Okay.
JMC as a corporation will hold shareholder meetings
Mm.
where investors like Mr. Jones can vote on important matters like electing the board of directors who oversee the company's management.
Yeah.
Sometimes these meetings can get pretty intense.
Oh,
The book mentions proxy fights,
okay.
where groups of shareholders try to influence the company's direction by winning control of the board.
Wow. So it's not all just numbers and balance sheets?
Absolutely.
There's real drama and power struggles involved.
Absolutely. And these governance mechanisms are designed to protect shareholders and ensure the company is being run responsibly.
Okay.
Now, since we're talking about shares, let's zoom in on JMC's balance sheet as a corporation.
All right.
One thing that often trips people up is the distinction between authorized, issued, and outstanding shares.
I'll admit, I've always been a little fuzzy on that.
Yeah.
Can you break it down?
Of course. Authorized shares are the maximum number of shares JMC is allowed to issue as determined by its corporate charter.
Oh,
Think of it as the potential pool of shares.
okay.
Issued shares are the number of shares that have actually been sold to investors.
Okay.
And outstanding shares are the issued shares minus any shares the company has repurchased, which we'll talk about later.
So if JMC is authorized to issue 1,000 shares,
Mm-hmm.
but has only sold 500,
Yep.
there are still 500 shares out there that could be issued.
Precisely.
Okay.
And outstanding shares are particularly important because they are used to calculate earnings per share,
Okay.
a key metric for investors when evaluating a company's profitability.
Okay. So managing how many shares are out there is a strategic decision for JMC.
Yeah.
And speaking of strategic decisions, what about those profits that JMC is hopefully generating?
Ah, yes. That brings us to retained earnings.
Okay.
These are the profits that JMC chooses to reinvest back into the business,
Okay.
rather than distributing as dividends.
Got it.
Retained earnings are like building blocks for growth,
Hmm.
enabling the company to expand operations, develop new products, or even acquire other companies, all without needing to issue more stock.
So retained earnings are like fuel for the JMC machine.
Exactly.
It's how the company can grow and become even more profitable in the future.
Exactly. And, it's fascinating how these seemingly simple concepts like costs and expenses and retained earnings actually underpin the entire financial system.
Wow.
From a small mousetrap company to a multinational corporation, these principles are at play.
Yeah, it's incredible how we can start with something as basic as building a mousetrap
I know, right?
and end up with these crucial insights into how businesses operate and grow.
It really is. And speaking of growth, we're about to explore how JMC can tap into the stock market to fuel even more expansion.
Okay.
Get ready for a deep dive into the exciting world of IPOs and stock offerings.
Let's do it. Okay, so JMC, our mousetrap company, they're doing well.
Yeah.
They've got, mousetraps flying off the shelves, but they've hit a snag.
Okay.
They need a bigger factory to
Well,
keep up with demand.
Yeah, this is a classic challenge for a growing business.
Yeah.
They've outgrown their current capacity and need capital to expand.
Okay.
And the book frames this as the debt versus equity dilemma.
Okay, so let's say they need, I don't know, $200,000 for this new factory.
Right.
Do they take out a massive loan or issue more stock? What are the pros and cons of each approach?
Well, both options come with trade-offs.
Sure.
Taking on more debt increases the company's financial leverage,
Okay.
meaning they'll have higher interest payments each month.
Right.
But it allows Mr. Jones and the existing shareholders to maintain their ownership stake.
So there's less dilution,
Right.
but more financial risk if things go south.
Exactly.
What about issuing more stock?
Well, issuing stock can dilute the ownership of existing shareholders like Mr. Jones, as each share now represents a smaller piece of the pie.
Right.
However, it can be a less risky way to raise a large sum of money
Right.
because there's no debt to repay.
Interesting. So JMC has to weigh these factors carefully.
Yeah.
The book actually walks us through their decision to take out a 5-year term loan
Okay.
for this expansion.
Right.
What exactly is a term loan?
So a term loan is essentially a loan with a fixed interest rate
Okay.
and a set repayment schedule over a specific period.
Okay.
In JMC's case, they agree to pay back a portion of the principal each year,
Okay.
which is known as a sinking fund.
A sinking fund. Is that like a piggy bank for loan repayment?
It's similar in concept, yeah.
Okay.
It's a way for JMC to gradually chip away at the principal over time.
Okay.
And then at the end of the 5 years, there's usually a larger final payment
Okay.
called a balloon payment to fully repay the loan.
Ah, so it's like a hybrid approach to repayment.
Right.
But the book mentions that the interest rate on a term loan depends on the borrower's creditworthiness.
Good point.
What does that mean for JMC?
So the bank will scrutinize GMC's financial statements,
Okay.
particularly their balance sheet and income statement,
Mm-hmm.
to assess their ability to repay the loan.
Okay.
Look at factors like JMC's revenue, profitability, and existing debt levels
Mm-hmm.
to gauge their financial health and determine how risky this loan is.
So it's not just a matter of how much money JMC needs.
All right.
It's also about their track record
Correct.
and financial stability.
Exactly.
The bank wants to feel confident that they'll get their money back.
Yeah, they want to make sure they're going to get paid back.
Now, let's say JMC decides to go the equity route instead.
Okay.
What are the key considerations there?
Well, as we touched upon earlier, the big one is dilution.
Right.
When JMC issues more shares, each existing share represents a smaller percentage of ownership.
Okay.
This can potentially lower earnings per share.
Right. Because now those earnings are spread out over a larger number of shares.
Exactly.
I can see how that might not make existing shareholders very happy.
Exactly. But here's where it gets interesting.
Okay.
The book explains that a higher price-to-earnings ratio,
Okay.
or PE ratio, can actually lessen the impact of dilution.
Okay, remind me, what's the PE ratio again?
So the PE ratio is basically the market price per share divided by the company's earnings per share. It's a measure of how much investors are willing to pay for each dollar of earnings.
Okay.
A higher PE ratio often indicates that investors have high expectations for the company's future growth.
So if investors believe that JMC is on the verge of a major breakthrough,
Right.
they might be willing to pay a premium
Exactly.
for its shares, even with some dilution.
That's exactly right. A high PE ratio gives companies like JMC more flexibility.
Yeah.
They can raise a significant amount of capital by selling fewer shares,
Mm-hmm.
minimizing the dilution for current shareholders.
Okay.
It also highlights the importance of market perception and investor confidence in a company's future.
It's all connected.
It is.
This brings us back to the fundamental question of
Yeah.
why the stock market exists in the first place.
Right.
I mean, what's the point of all this buying and selling of company shares?
So at its core, the stock market is a mechanism for companies to raise capital
Okay.
from investors who believe in their potential.
Okay.
It's a way for businesses like JMC to fuel their growth and innovation
Mm-hmm.
by tapping into a vast pool of capital.
Okay.
And for investors, it's an opportunity to participate in that growth and potentially reap financial rewards.
Okay. The book talks about different types of stock offerings,
Yep.
like primary and secondary offerings.
Yeah.
What's the difference between those?
So a primary offering is when a company like JMC issues new shares and directly receives the cash from the sale.
Okay.
This is how they raise capital for expansion, new projects, or to pay down debt.
Okay.
A secondary offering, on the other hand, is when existing shareholders sell their shares,
Okay.
and they, not the company, receive the proceeds.
Okay, so in a primary offering, JMC gets the money.
Yes.
And in a secondary offering, an investor who
Right.
owns JMC stock
Right.
gets the money.
Right.
It seems like every time someone buys or sells stock on the market,
Yeah.
that could be considered a secondary offering?
Well, not quite.
Okay.
Every stock trade involves a buyer and a seller, but the term secondary offering is usually reserved for situations
Okay.
where a large block of shares held by an insider,
Okay.
like Mr. Jones
Mm.
or an institution, is being sold to the public.
Ah, so it's about the scale
Right.
and the source of
Yes.
those shares.
Exactly.
Well, it's good to have those nuances clarified.
Yeah.
Now, the book also mentions IPOs
Yes.
or initial public offerings.
Yeah.
What's the significance of an IPO?
So an IPO is a major milestone for any company.
Okay.
It marks their transition from a private company to a publicly traded one,
Okay.
meaning their shares can be bought and sold on a stock exchange.
Got it.
It's often a time of great excitement
Okay.
and can attract significant investor attention.
So why would a company choose to go public?
Right.
Is it just about raising a ton of money?
It's definitely a major factor.
Okay.
IPOs can generate a huge influx of capital,
Mm-hmm.
which can be used to fund expansion, research and development, or even acquisitions.
Mhm.
But it's not just about the money.
Okay.
Going public can also boost a company's profile and prestige,
Okay.
attracting top talent and making it easier to secure partnerships.
Interesting. It's like leveling up
It is, yeah.
in the business world.
Yeah, it's a big step.
But going public also comes with increased scrutiny and regulations, right?
Absolutely.
I mean,
Once a company goes public, they are subject to more stringent reporting requirements and oversight from regulatory bodies,
yeah.
like the Securities and Exchange Commission.
Mhm.
They also have to answer to a broader base of shareholders,
Okay.
which can sometimes create pressure to prioritize short-term profits over long-term goals.
Okay, so there's definitely a balancing act involved.
For sure.
The book also points out some common misconceptions about what happens
Yeah.
after a company has already gone public.
Mm-hmm.
Sometimes people get confused when a company issues new shares after its IPO.
Yes. Some people mistakenly call these secondary offerings,
Okay.
which can be misleading. It's important to remember that even after an IPO, when a company issues new shares, it's still a primary offering.
Right.
The company, not existing shareholders, is the one receiving the capital from the sale.
Gotcha.
To avoid confusion, the book suggests calling these follow-on offerings.
Okay, that's a good distinction to keep in mind.
Yeah.
Now, before we move on to even more complex financial instruments,
Okay.
I want to circle back to something fundamental.
Yeah.
What motivates people to start companies in the first place?
Yeah.
It seems like a lot of hard work and risk.
It is, yeah.
Eh.
That's a great question. Of course, there's the entrepreneurial spirit,
Yeah.
the drive to create something new and
Yeah.
make a difference in the world.
Yeah.
But let's be honest, the profit motive plays a big role as well.
Sure.
The potential to build something valuable, disrupt an industry,
Yeah.
and reap the financial rewards is a powerful motivator.
Yeah, in Mr. Jones's case, he still retains a majority ownership stake in JMC, which gives him a huge incentive to see it succeed.
Of course.
And as the company grows, he can use stock options to motivate his employees.
Yeah, stock options are a fascinating tool for
Yeah.
aligning incentives between a company and its employees.
Aye.
They give employees the right to buy shares of the company at a set price in the future.
Okay.
If the company performs well and the stock price goes up,
Mm-hmm.
the employees can buy those shares at the lower price
Right.
and profit from the difference.
So it's a way to give employees a stake in the company's success.
Yep.
They have a direct incentive to work hard
Uh-huh.
and contribute to JMC's growth.
Absolutely.
And it can be incredibly effective for attracting and retaining top talent.
It can be.
Now let's dive into some more technical aspects of stocks.
Okay.
The book talks about things like stock splits and
Yeah.
stock dividends.
Yeah.
Stock splits, I've always wondered about those.
Oh, yeah.
What's the point of a company
Yeah.
splitting its stock?
They might sound complicated, but stock splits are actually quite straightforward.
Okay.
Let's say JMC does a 2-for-1 stock split.
Okay.
This means that for every share an investor owns,
Mm-hmm.
they'll receive 2 shares.
Okay.
The company doubles the number of shares outstanding,
Okay.
but cuts the price of each share in half.
So it's like cutting a pizza into more slices.
That's a great way to think about it, yeah.
Okay.
A stock split doesn't change the fundamental value of the company
Okay.
or an investor's overall holdings.
Okay.
However, it can make the stock more accessible to a wider range of investors,
Okay.
potentially boosting demand and trading volume.
So it's a way to make the stock more affordable
Right.
for smaller investors who might have been hesitant to buy at the previous higher price.
Exactly.
What about stock dividends?
Mhm.
How are those different from stock splits?
So stock dividends are similar to stock splits in that they increase the number of shares outstanding.
Okay.
But instead of simply splitting the existing shares,
Mm-hmm.
the company issues new shares to existing shareholders as a dividend payment.
Okay.
So if JMC declares a 10% stock dividend,
Okay.
an investor with 100 shares will receive an additional 10 shares.
Okay, so both stock splits and stock dividends result in more shares in
Right.
circulation. But with a stock dividend, those new shares are essentially a reward for
Exactly.
being a shareholder.
Yep, like a little bonus.
It's like a bonus on top of any
That's it.
cash dividends the company might pay.
Right, and the book highlights that these actions, while seemingly technical,
Yeah.
can be signals to the market about the company's financial health and future prospects.
Okay.
Companies often use stock splits and dividends to attract new investors
Yeah.
or reward existing ones,
Sure.
especially if they believe their stock is undervalued.
It's fascinating how all these pieces fit together,
It is.
from the financial statements
Yeah.
to the decisions that companies make about financing and,
Yeah.
and rewarding shareholders.
Absolutely.
Speaking of financing, we've talked about debt and equity, but the book introduces another option,
Okay.
bonds. Can you explain how those work
Sure.
and why a company might choose to issue bonds?
So bonds are essentially loans.
Okay.
But instead of borrowing from a bank,
Okay.
companies borrow directly